Yes, good morning, good afternoon, good evening to all South India students. Hope so you are good. I am also well. So hope so you're done with the revision lecture number 1 that was related to tax rate. Today we are going to revise the topic capital gain. So capital gain charging section is 45(1), means when capital gain is applicable. So as per section 45(1), any profit or gain arising from transfer of capital asset shall be taxable under the head capital gain in the year in which transfer took place. So from charging section, 3 things is very clear. First is there should be a capital asset. That capital asset should be transferred. And third, capital gain will be taxable only in the year in which transfer took place. Whether you receive the consideration or not, that is irrelevant. Capital gain will be taxable in the year in which transfer took place. Now first section is what is the meaning of the capital asset. So capital asset is basically defined in section 2 clause 14, and as per 2 clause 14, property of any kind held by SSC. Any kind means whether it is movable, immovable, tangible, intangible, whether it is connected with your business or not, that is a capital asset. So I can say that in one line they covered the all asset of this particular planet. They covered the all asset, means all asset are treated as capital asset, but basically 4 asset are excluded from the definition of capital asset. First exclusion is a stock in trade. A stock in trade is not a capital asset because obviously whenever you transfer the stock in trade, then income is taxable under the head business and profession, or you can say that PGBP. Second is a movable personal asset. Whenever you transfer the movable personal asset, that is not treated as capital asset, capital gain is not applicable. Now question is that what is the meaning of personal asset? Personal asset means asset which is used by assessee or his dependent family member for the personal purpose, that is called your personal asset. So whenever you transfer the movable personal asset, then capital gain is not applicable because it is not treated as capital asset. But now try to understand, there are 6 assets. These 6 assets are movable personal asset, but capital gain will be applicable. That is jewelry, drawing, painting, sculpture, archaeological collection, any other work of art. Jewelry, drawing, painting, sculpture, archaeological collection, any other work of art. These 6 assets are movable personal asset, but whenever you transfer this asset, then capital gain is applicable. Third exclusion is a rural agriculture land in India. If you transfer any rural agriculture land in India, then capital gain is not applicable. But what is the meaning of the rural agriculture land in India? So rural agriculture land in India means, rural agriculture land means land which is situated in rural area. But question is that what do you mean by rural area? So rural area is basically area which is not an urban area. But what is the meaning of urban area? Urban area is area which is not a rural area. Is it like that? Answer is no. So what is the meaning of rural agriculture land in India? So rural agriculture land in India means land situated in rural area. But what do you mean by rural area? Rural area is area which is not an urban area. But what is the meaning of urban area? Urban area is defined in the law. And urban area means any municipality area or cantonment board area where population as per the last census is 10,000 or more. Population of that area is 10,000 or more, that area will be treated as the urban area. If that population is more than 10,000 up to 1 lakh, then 2 kilometers surrounding area is also treated as urban area. If that population is more than 1 lakh up to 10 lakh, then 6 kilometers surrounding area is treated as the urban area. And if that population is more than 10 lakh, then 8 kilometers surrounding area is treated as your urban area. Now next part is related to the next part, gold deposit bond 1999 and deposit certificate issued under gold monetization scheme 2015. These 2 bonds or certificate are not treated as the capital asset. You got my point or not? Okay. So what is the meaning of capital asset? Here capital asset means property of any kind held by SSC, whether it is movable, immovable, tangible, intangible, whether it is connected with business or not. But there are 4 exclusions. First is a stock in trade, second is a movable personal asset, third is a rural agriculture land in India, and fourth is a gold deposit bonds 1999 and deposit certificate issued under gold monetization scheme 2015. Now try to understand one more thing. Any security held by the FII, that is foreign institutional investor, as per the RBI guidelines, that security will be treated as always capital asset, means always capital gain will be arise irrespective of the quantum of security or volume of transaction and all. Whatever security held by FII is always treated as capital asset and capital gain will arise. Now next part we are going to start with the definition of transfer. Next part is a transfer. What do you mean by the transfer? So transfer include the sale, exchange, relinquishment, extinguishment, conversion of capital asset into stock in trade, compulsory acquisition of capital asset. In case of zero coupon bond, if there is a redemption, then it is treated as the transfer. And in case of the immovable property, possession is transfer, it is treated as transfer. And in case of cooperative housing society and all, if your share certificate is transfer, then it is treated as a transfer of capital asset. So what do you mean by transfer? All people please pay attention. So transfer means sale, exchange, relinquishment, extinguishment. conversion of capital asset into stock in trade, compulsory acquisition of capital asset, redemption of zero coupon bonds. In case of immovable property, if possession is handed over, it is treated as the transfer, and in case of the cooperative housing society and all, if your share certificate of that property is transfer, it is treated as the transfer. Now there are basically two types of capital asset. One is the long term, one is the short term. Why long term and short term? Because in case of long term, indexation benefit is available, but in case of the short term, index benefit is not available. Second thing, in case of the long term capital gain, tax rate is lower as compared to the short term capital gain. So what do you mean by the long term capital asset and short term capital asset? All people please pay attention. All people please pay attention. First part, in case of any security but other than unit, any security other than unit listed in any recognized stock exchange in India, UTI units and mutual fund equity oriented units and zero coupon bonds, period of holding you have to check for 1 year. If it is held for more than 1 year, then there is a long term capital asset, otherwise short term capital asset. So what I explain, all people please pay attention. In case of the security, any security but other than unit, any security other than unit listed in any recognized stock exchange in India, UTI का units, mutual fund का equity oriented unit and zero coupon bonds, 1 year period of holding. In case of immovable property and shares of company, means shares which were not covered in the first part. So shares of the company and immovable property, there is a period of holding of 2 years, and in case of any other asset, period of holding you have to check is 3 years. Now try to understand how to compute the capital gain. So computation of capital gain is defined in section 48, and as per section 48 you have to check the how you will calculate the capital gain. First, take the full value of consideration minus transfer expenses, cost of acquisition, cost of improvement. You will get your amount of capital gain. But now try to understand one thing. Suppose I purchased one plot of land 10 years ago, and in the last year only I constructed one building, and in the current year I am selling that land and building together for 50 lakh rupees. So question is that I have to calculate the capital gain on that plot and that building separately or combined. Right answer is separately. As per the case law of the Supreme Court, if your land was long term and building is short term, then you have to bifurcate the consideration between two parts towards the land and building, and on land there will be a long term capital gain, and on building there will be a short term capital gain. Now next part is related to, sir, question is that how to calculate capital gain, and in the section 48 there is a second proviso. Second proviso is saying that if there is a long term capital asset, then your cost of acquisition and cost of improvement you have to take as index cost of acquisition and index cost of improvement. But how you will calculate convert your cost of acquisition into index cost of acquisition? So please try to understand. For index cost of acquisition, just take the cost of acquisition, multiply by index of the year of transfer and divide by index of the year of acquisition. And for index cost of improvement, take the cost of improvement, multiply by index of the year of transfer, divide by index of the year of improvement. Now this index number, you have to just remember that 1 to index number was the 100, and for your examination, that is financial year 1920, your index number is 289. If any asset is acquired before 1/4/2001, then you can take the cost of that asset or fair market value as on 1/4/2001, whichever is higher. So you have an option that if any asset is acquired before 1/4/2001, because indexes start from the 1st April 2001, so if any asset is acquired before 1/4/2001, then you have to take the cost or FMV as on 1/4/2001, whichever is higher. Now try to understand one more thing. Any improvement done before 1/4/2001 you have to ignore. Any improvement done before 1/4/2001 you have to ignore, because that improvement factor is already included in FMV as on 1/4/2001. Now there is a first proviso to section 48, and as per the first proviso to section 48, in case of the non-resident, you know that normally we calculate the capital gain in Indian currency, but this is the one case in which you have to calculate the capital gain in foreign currency and after that reconvert into the Indian currency if 3 conditions are satisfied. This proviso is applicable if 3 conditions are satisfied. First condition, assessee should be non-resident. Asset is a share or debenture of Indian company, and if that asset were acquired in the foreign currency, then capital gain you have to calculate it in foreign currency and after that reconvert into the Indian currency. Now question is that how you will calculate the capital gain in foreign currency. First, take the full value of consideration. You will get the examiner will give you the full value of consideration in Indian currency. You have to convert it into the foreign currency by applying average rate on the date of transfer. Now question is that what is the meaning of average rate? Average rate means TTBR plus TTSR divided by 2. TTBR means telegraphic transfer buying rate, TTSR means telegraphic transfer selling rate, and divided by 2 means there will be the average of TTBR and TTSR, that is average rate on the date of transfer. So full value of consideration convert by average rate on the date of transfer. Your transfer expenses, average average rate on the date of transfer, your cost of acquisition average rate on the date of acquisition, and whatever capital gain you get into the foreign currency, first convert it into the Indian currency, but you will convert that capital gain into Indian currency by applying the TTBR on the date of transfer. You have to take the TTBR on the date of transfer, means your full value of consideration, transfer expenses and cost of acquisition you are going to convert into foreign currency by average rate, but your capital gain converted into Indian currency by TTBR on the date of the transfer. Now you got my point or not? Yes. Now one more point. In this proviso, whenever you calculate the capital gain, then second proviso to section 48 is not applicable. It means indexation benefit is not available. Whether there is a long-term capital asset or short-term capital asset, means even there is a long-term capital asset, then also indexation benefit is not available. In technical language, I can say that wherever first proviso to section 48 is applicable, then second proviso to section 48 is not applicable. Now next part is the third proviso to section 48. And third proviso is saying that if section 112A is applicable, 112A means long-term capital gain on equity share, equity oriented mutual fund, units of business trust, sale through recognized stock exchange, STT paid and all that. So if 112A is applicable, then first and second proviso both is not applicable. So as per third proviso, if there is a 112A long-term capital gain, in that case first and second proviso is not applicable. Now fourth proviso to section 48. Fourth proviso is saying that in case of the debenture and bonds, index benefit is not available. In case of debenture and bonds, index benefit is not available. Because you know that debenture and bonds is like a loan. So like in case of, obviously it is like value will not increase with inflation. So in case of the debenture and bonds, index benefit is not available, but there are two exceptions. One is the capital index bonds and one is the sovereign gold bond issued by RBI. So in case of the sovereign gold bond issued by RBI and in case of the capital index bond, index benefit is available. In case of other bonds and debenture, index benefit is not available. Now try to understand one more thing. In case of the sovereign gold bond issued by RBI, if you subscribe the sovereign gold bonds and at the time of redemption will be after 8 years normally as per the sovereign gold bond scheme. Redemption will be at the at the end of the 8 year. So if there is a redemption of sovereign gold bond and assessee is individual, then capital gain is totally exempt due to section 47. So in simple language, I can say that suppose if you are an individual, and there is a maturity on the redemption of the sovereign gold bonds at the 8 year, then there is no capital gain due to section 47. But suppose if you transferring before the maturity, in that case capital gain is applicable and index benefit is also available. You got my point or not? Yes. And in case of any other assessee, even there is a like at the time of maturity or transfer before maturity, capital gain is applicable and index benefit is also available. Now try to understand next part, that is the fifth proviso to section 48. And as per the fifth proviso to section 48, in case of non-resident assessee, if any non-resident assessee acquired rupee denominated bonds of Indian company, any non-resident acquired means purchase or subscribe both. If any non-resident acquired rupee denominated bonds of Indian company and at the time of redemption, if there is a gain due to rupee appreciation, if there is a gain due to rupee appreciation, then on that gain, capital gain is not applicable, or I can say that that gain will not be included in your full value of consideration. So fifth proviso is saying that if in case of the non-resident, if non-resident acquired the rupee denominated bonds of Indian company and at the time of redemption, not before redemption sale, no, or only at the time of the redemption, if there is a gain due to the rupee appreciation, and on that gain, capital gain is not applicable. Now next proviso is the sixth proviso that we will discuss with the section 47. Next is the seventh proviso. As per section 7, as per the seventh proviso to section 48, STT is not allowed under the head capital gain. STT is not allowed under the head capital gain means whenever, if you pay the STT at the time of sale, then it will not be treated as your transfer expenses, and STT paid at the time of purchase, it will not be included in your cost of acquisition. So what I am saying that all people please pay attention. STT is not allowed under the head capital gain. If you pay the STT at the time of sale, it is not treated as transfer expenses, and STT paid at the time of purchase, it is not included in your cost of acquisition. Now next part is related to the section 55. Section 55 is a cost of acquisition and improvement. So what is the meaning of cost of acquisition? Means whatever cost you paid at the time of acquisition, that is treated as cost of improvement, cost of acquisition. And cost of improvement means whatever capital expenditure incurred for improvement of that asset is treated as cost of improvement. But there are certain special cases. First part is related to intangible asset. Sir, what will be the cost of acquisition in case of the intangible asset? like goodwill of business and all. So section 55 is saying that in case of intangible asset, they include certain asset. First is the goodwill of business. Second is a trademark, brand name, right to manufacture, produce, process any article and things, that is patent and copyright, right to carry on any business and profession, and tenancy right, loom, arts and route permit in case of this asset. Here, intangible asset covered 8-9 asset. First is the goodwill of business, not profession. Profession is still not covered here. Only goodwill of the business. In case of goodwill of business, second is a trademark, brand name, patent, copyright, right to carry on any business and profession, tenancy right, loom, arts and route permit. In case of this asset, what will be the cost of acquisition? If these assets are self-generated, then you have to take the cost of acquisition as a nil. You have to take the cost of acquisition as a nil, but if this asset are purchased, then whatever purchase price will be treated as your cost of acquisition. So in case of this intangible asset, if assets are self-generated, then take the cost of acquisition as nil. If it is a purchase, then purchase price will be treated as your cost of acquisition. Now next part, try to understand, in case of this intangible asset, FMV benefit of 1/4/2001 is also not available. Means whatever asset acquired before 1/4/2001, then obviously you will get the benefit of FMV as on 1/4/2001. But in case of intangible asset, FMV as on 1/4/2001 benefit is not available, whether it is self-generated or it is purchased. Now next part is related to bonus share. What will be the cost of acquisition of bonus share and security? So in case of bonus share and security, obviously your cost of acquisition will be nil. But try to understand, if bonus share is acquired before 1/4/2001, then whatever FMV is on 1/4/2001, that will be your cost of acquisition. So in case of bonus share, your cost of acquisition will be nil. But if bonus share is acquired before 1/4/2001, because bonus share allotted before 1/4/2001, then FMV as on 1/4/2001 benefit is available. So whatever FMV as on 1/4/2001, that will be treated as your cost of acquisition of bonus share. Now try to understand one more thing. If section 112A is applicable, we will discuss section 112A after some time, but if section 112A is applicable, in that case FMV as on 31st January 2018, FMV will be treated as your cost of acquisition in case of the bonus share. So what I am saying, that normally bonus share cost will be nil. But bonus share acquired before 1/4/2001, then FMV as on 1/4/2001 will be your cost of acquisition. And if section 112A is applicable, then obviously you will get the benefit of FMV as on 31st January 2018. Then in case of bonus share also, you can take the benefit of 31 Jan 2018 FMV. Now next part is related to right share. What will be the cost of acquisition of right share? Obviously whatever amount paid to the company, that will be the cost of acquisition of right share. So suppose now you know that 10-12 days ago, Reliance given the offer of the right share and all. So now suppose I am a Reliance shareholder and I am going to subscribe the right share from Reliance, and Reliance issued that share at 1200 rupees. Then what will be the cost of acquisition? 1200. Whatever amount paid to Reliance, that will be my cost of acquisition. But suppose I am not going to subscribe that right share and I am renouncing that right to someone. Like suppose you want to subscribe that right share, but you don't have that right, and I am going to renounce the right in favor of you. Then in case of renouncement also capital gain is applicable. Suppose I renounce the right, not right share, right to you for 100 rupees per right. In that case, capital gain is applicable in my hand. Now question is that what will be the full value of consideration? That renouncement price is full value of consideration. Cost of right, answer is nil. There is no cost of right, and whatever the amount, whatever renouncement price, that will be treated as your short-term capital gain. Why short-term capital gain? Because period of holding of right will be considered from the offer date till the renouncement date. Offer date till the renouncement date, and from offer date to the renouncement date, it will never be more than 3 years. So here it will be always be a short-term capital gain. You got my point or not? Yes. Now question is that what will be the cost of acquisition in your hand? So in your hand, cost of acquisition will be whatever amount paid to company plus amount paid to the BB sir. Means amount paid to company plus cost of that right. That total will be treated as your cost of acquisition. But what will be the period of holding in case of share and security? Try to understand, always in case of share and security, your period of holding will be considered from the allotment date. Whatever the allotment date, from allotment date, your period of holding will be considered. You got my point or not? Yes. Now next part is related to in case of the corporatization or demutualization of stock exchange. You know that BSE and NSE earlier were AOP BOI. But now it is converted to the company. Now it is a BSC Limited. Earlier were AOP BOI. And suppose we can take one example. Motilal Oswal was the member of that AOP BOI. So earlier all share broker were the member of AOP BOI, and they have to acquire the membership card of that AOP BOI. So suppose Motilal Oswal was purchased membership card of BSC for rupees 5 crore. Now it is converted into the company. So Motilal Oswal is going to get the share of the BSC Limited. So now question is that what will be the cost of acquisition of that share? So cost of acquisition of that share will be whatever membership card cost. Whatever membership card cost, that will be treated as the cost of acquisition of share. And also Motilal Oswal is going to get the trading and clearing right. So what will be the cost of acquisition of trading and clearing right? The trading and clearing right cost of acquisition will be treated as the nil. Means you have to take the nil as a cost of acquisition of trading and clearing right. You got my point or not? Yes. Now next part is related to any other capital asset. Obviously, what will be the cost of acquisition of any other capital asset? Whatever cost incurred, that is cost of acquisition. If it is acquired before 1/4/2001, then FMV as on 1/4/2001 or cost whichever is higher will be treated as your cost of acquisition. Now next part is related to cost of improvement. What do you mean by cost of improvement? So cost of improvement means any capital expenditure incurred for improvement of asset is treated as cost of improvement. So cost of improvement you have to consider only if improvement took place on or after 1/4/2001. But try to understand in case of three assets. One is the goodwill of business. Second is the patent and copyright. Third is the right to carry on any business and profession. In this three asset, always treat cost of acquisition as a nil only. Means always consider nil cost of improvement. Cost of improvement in this three asset. One is the goodwill of business, patent and copyright, and right to carry on any business and profession. In case of this three asset, cost of improvement is always nil. But in case of any other asset, whatever improvement took place on or after 1/4/2001 will be treated as your cost of improvement. You got my point or not? Yes. Now next part is related to 49.5. That is income declaration scheme. In 2016, Modi government announced one scheme. Name is the IDS, that is Income Declaration Scheme 2016. Now this scheme was applicable between 1st June 2016 till 30th September 2016 for 4 months basically. Now as per that scheme, like you can disclose all your black money or black asset, just you have to pay the 45% tax including penalty and interest. You have to just pay the 45% and your money will be the white money. So in that scheme, they they offer, they given one option that you can disclose your property also. So suppose I can take one example. In 2007, I purchased one flat for 1 crore rupees. I purchased one flat for 1 crore rupees, but that was out of the black money. Now, in IDS scheme, if I want to disclose that flat, then I have to pay the tax at the rate 45% on the whatever fair market value as on 1st June 2016. So suppose that flat I purchased for 1 crore, but on 1st June 2016 that FMV was 5 crore. So just I have to pay the 45% tax on that 5 crore. Then my property will be treated as now white property, you can say that. Now question is that what in 2020, suppose I am going to sell that flat, then what will be the cost of acquisition? So my cost of acquisition will be the FMV as on 1st June 2016. Means whatever FMV I disclose under IDS scheme, that FMV will be treated as my cost of acquisition. So that 5 crore will be treated as my cost of acquisition. So as per section 49.5, I can say that if any property is declared under the income declaration scheme 2016, then whatever FMV as on 1st June 2016, that will be treated as your cost of acquisition. Now try to understand what will be the period of holding. Obviously, period of holding will also be from 1st June 2016 only, but there is one exception. If there is an immovable property and that immovable property got registered, means if there is an immovable property and immovable property got registered, in that case, whatever the purchase date, means from purchase date, you can take your period of holding. So normally what will be the period of holding? So period of holding will be from 1st June 2016 only. But immovable property registered by the registered deed, in case like suppose immovable property is registered, in that case whatever your purchase date will be treated, from purchase date you can take your period of holding. Now indexation will be from 1617 only. Indexation will be from 1617 only. You got my point or not? Yes. So this is all about section 45 subsection 5. Now next part is related to the exception of section 45(1). Now you know that as per section 45(1), capital gain is taxable in the year in which transfer took place. Capital gain is taxable in the year in which transfer took place, but there are basically 4 exceptions. First exception is of 45 subsection 2, that is conversion of capital asset into stock in trade. Now normally capital gain is taxable in the year in which transfer took place, but this is the first exception, that is conversion of capital asset into stock in trade. In case of conversion of capital asset into stock in trade, your transfer is took place in the year of conversion, but you have to pay the tax in the year only, in the year in which a stock is sold. Means you have to pay the capital gain tax in the year in which a stock in trade is sold. Now, how you will calculate the capital gain or business income? So capital gain as well as business income both will be taxable in the year in which a stock in trade is sold. First, capital gain. So for capital gain, take the full value of consideration is FMV as on date of conversion minus cost of acquisition, cost of improvement, index cost of acquisition, index cost of improvement. You will get your capital gain amount. And for business purpose, whatever sale value of the stock and that FMV of that capital asset on the date of conversion, that will be treated as your business cost and there will be a business income. Now try to understand this business income and capital gain income both will be taxable in the year in which a stock in trade is sold. Now question is that, sir, if proportionate stock in trade is sold, then if your stock in trade is sold proportionately, then capital gain is also taxable proportionately. You got my point or not? Yes. Now there is a one Cbdt circular, and that Cbdt circular is related to section 54 EC. In case of section 54 EC, you know that you can invest in the NHI, RECL, PFCL or IRFCL bonds. And what will be the time limit for acquiring that bond? That is 6 months from the date of transfer. But in case of section 45(2), suppose if section 45(2) is applicable, in that case that 6 month time limit will not be calculated from the date of transfer. It will be calculated from the date on which a stock in trade is sold. Now next part is related to conversion of stock in trade into capital asset. Sir, what will happen if we convert our stock in trade into capital asset? Then what will happen? So try to understand. They introduce some provision by the Finance Act 2018, and that this is the basically reverse situation, you can say that. Suppose I am having some stock in trade and stock in trade is converted into capital asset. So lawmaker is saying that whenever you convert your stock in trade into capital asset in that year, whatever FMV, on that FMV you have to pay the PGBP tax, or you can say that that income will be taxable under the head PGBP. So what I am saying that all people please pay attention. If your stock in trade is converted into capital asset, so in the year in which conversion took place, in that year only you have to pay the tax on your business income, and whatever FMV as on the date of conversion, that will be treated as cost of acquisition of that capital asset. Cost of acquisition of that capital asset. You got my point or not? Okay. There is one difference basically between both the provision. First provision we discussed that conversion of capital asset into stock in trade. In case of conversion of capital asset into stock in trade, your capital gain and business income both will be taxable in the year in which a stock in trade is sold. But like in this scenario, in case of conversion of stock in trade into capital asset, your business income will be taxable in the year in which conversion took place, and capital gain will be taxable in the year in which capital asset will sold. And what will be the cost of acquisition of capital asset? Whatever FMV as on date of conversion will be treated as your cost of acquisition of capital asset. You got my point or not? Yes. Now next part is related to the compulsory acquisition of capital asset. Compulsory acquisition of capital asset is treated as transfer. Capital gain is applicable. Normally capital gain is applicable in the year of transfer, but here there is an exception. As per section 45 subsection 5, in case of compulsory acquisition of capital asset, your transfer is took place in the year in which asset is compulsorily acquired, but tax will be paid in the year in which compensation is received. Tax will be paid in the year in which compensation is received. Now how you will calculate the capital gain? So suppose first you receive the initial compensation, then full value of consideration will be the initial compensation minus cost of acquisition, cost of improvement. Capital gain will be applicable in the year in which initial compensation is received. Suppose assessee not satisfied with initial compensation and he file a case to the High Court or Supreme Court or any authority, and your compensation is increased or enhanced. In that case, on that enhanced or increased compensation, your capital gain will be applicable in the year in which that enhanced compensation is received. So if you receive initial compensation, tax on that compensation will be taxable in the year in which initial compensation is received. If compensation is enhanced, in that case, your additional, whenever you will receive the additional compensation, in that year, your capital gain will be applicable. Now try to understand one more thing. Whenever you will receive the additional compensation or enhanced compensation, how you will calculate the capital gain? First, full value of consideration will be additional compensation minus cost of acquisition, cost of improvement. Is you will reduce the cost of acquisition, cost of improvement? Again, answer is no, because you already reduced while calculating capital gain at the time of receipt of your initial compensation. So obviously cost of acquisition, cost of improvement you will not reduce, but you can reduce the one thing, that is the legal charges or litigation charges. If there is any legal charges or litigation charges, you can reduce from your enhanced compensation and you will get your amount of capital gain. Now question is that on enhanced compensation, that capital gain will be long term or short term? That will depend on your original computation. at the time of initial compensation. If at the time of initial compensation there were long-term capital gain, in that case on enhanced compensation also there will be a long-term capital gain, because you know that like capital gain nature will depends on the period of holding of your asset. Your asset was long-term, in that case capital gain will be long-term, initial or enhanced both. And if your asset was short-term, in that case your capital gain will be short-term, additional or like initial, both you can say that. Now try to understand, if you receive the compensation in installment, then what will happen? In case of initial compensation, if your initial compensation is received in installment, then whole initial compensation will be taxable in the year in which first installment is received. Because initial compensation, government, like you know that there is a fully assurance of initial compensation. There is a 100% assurance of initial compensation. If you receive the initial compensation in installment, then whole initial compensation will be taxable in the year in which first installment is received. But if enhanced compensation is received in installment, then it will be taxable as and when received. As and when received means whenever like you will receive the enhanced compensation in each installment, tax will be like applicable on the each installment, or I can say that enhanced compensation is received in installment, it will be taxable as and when received. But now try to understand one thing. If you receive the additional compensation or enhanced compensation due to any interim order of any court, what I am saying that if you receive additional compensation due to interim order of any court, in that case that compensation will be taxable only in the year in which final order is made. What I said that, all people please pay attention. If you receive the enhanced compensation due to interim order of any court, interim order means temporary order of any court, that will be taxable in the year in which final order is made. You got my point or not? Yes. Now try to understand, there is one Cbdt circular, and Cbdt circular is saying that there is a one act, that is Right to Fair Compensation and Transparency in the Land Acquisition, Rehabilitation, Resettlement Act 2013. So there is a one separate act, and as per that separate act there is one section 96, and as per section 96 there are certain mode of compulsory acquisition where tax is not applicable. But you know that corresponding amendment is not made in the Income Tax Act. So there were one question, is like there is no amendment in the Income Tax Act, so capital gain is applicable or not? So as Cbdt clarify that if that like compulsory acquisition is fall under section 96 of that particular act, in that case in income tax also capital gain is not applicable, so don't worry about that. Now whenever you receive the late compensation, then obviously you are going to get the interest on that late compensation. That interest will be taxable in the year in which it is received, and it will be taxable under income from other sources, and you are going to get the 50% deduction. Suppose you received the interest of 1 lakh, then only 50,000 interest is taxable. Now next section is section 45 subsection 1A, that is related to destruction of damage of capital asset. So normally in case of destruction or damage, capital gain should not be there because destruction is not treated as transfer. But as per section 45 subsection 1, your asset is destructed due to 4 reasons. One is a natural calamity, second is a right, third is an enemy attack, and fourth is a fire explosion. If your asset is destructed or damaged due to 4 reasons, that is natural calamity, right, enemy attack, and fire explosion, and if you received the insurance claim, then it is treated as transfer and capital gain is applicable. What I said that, all people please pay attention. If your asset is destructed due to the 4 reasons, that is natural calamity, right, enemy attack, fire explosion, and if you receive the insurance claim, in that case capital gain is applicable, it is treated as transfer. Now question is that what will be the full value of consideration? Your full value of consideration will be the insurance claim amount. And cost of acquisition, cost of improvement, you will get the amount of capital gain. Now try to understand, in this section your transfer will be took place in the year in which your asset is like destructed or destroy or demolish, or you can say that the damage. But tax will be paid in the year in which insurance claim is received. So your transfers took place in the year in which asset is destructed, but tax will be paid in the year in which insurance claim is received. Now try to understand one more thing. What will be the insurance claim? If you receive the money, then whatever insurance claim will be the money amount. But suppose if you receive another asset, then whatever FMV of asset received in return, that will be treated as your full value of consideration. Then that FMV, suppose if you transfer that new asset, then whatever FMV, that will be treated as the cost of acquisition of that asset. You got my point or not? Yes. Now next part is related to the joint development agreement. Now what is the concept of joint development agreement? Section 45 subsection 5A. Joint development agreement is basically, suppose if any person enter into the agreement with the builder, and that person transfer immovable property to builder, and builder is going to construct the project, and builder is going to give some share in that project. Suppose like builder is going to give the possession of 2-3 flat to that particular person. That concept is called joint development agreement. Now try to understand what I explained in section 247, that was transfer ka definition, and as per the transfer definition, in case of immovable property or possession is transfer, then it is treated as transfer, capital gain is applicable. But here, this is the exception. All people, please pay attention. In case of individual and HUF, first thing, this section is applicable only in case of individual and HUF. In case of individual and HUF is having some immovable property and they transfer that immovable property to builder under the joint development agreement. Then transfer took place in the year in which possession is handed over to builder, but tax will be paid in the year in which completion certificate of that project is received. Means what I am saying, that all people please pay attention. Your transfer took place in the year in which possession is handed over to builder, but capital gain will be taxable in the year in which CC is received by that builder. Whenever CC of that project or part of the project is received by builder in that year, like assessee, or I can say that individual or HUF is required to pay the tax. So section 45(5)(a) is saying that suppose individual or HUF is entering into the joint development agreement with the builder, then transfer took place in the year in which possession is handed over to builder, but tax will be paid in the year in which completion certificate of project is received. Now try to understand what will be the full value of consideration. Full value of consideration will be whatever stamp duty value of this individual HUF, means assessee share in that project, stamp duty value of assessee share in that project on the date on which CC is issued or completion certificate is issued. So whatever stamp duty value of assessee share in that project on the date on which CC is issued, and if suppose builder is also giving some cash or money, then that money should be forming part of, that should be added to your full value of consideration. Now after some time, suppose assessee transferred that share to another person, in that case whatever the full value of consideration at the time of computation of capital gain, that full value of consideration will be treated as the cost of acquisition of that asset. I already given you the two example, you can check, you will able to understand, don't worry about that. So this is the exception of section 45 subsection 1. So all people please pay attention, I am going to revise again the exception of section 45 subsection 1. 45 subsection 1 is saying that capital gain is taxable in the year in which transfer is took place, but there are basically 4 exceptions. First is the in case of conversion of capital asset into stock in trade, your transfer is took place in the year of conversion, but tax will be paid in the year in which a stock in trade is sold. In case of compulsory acquisition of capital asset, your transfers took place in the year in which your asset is compulsorily acquired, but tax will be paid in the year in which compensation is received. In case of destruction, your transfers took place in the year of destruction, but tax will be paid in the year in which insurance claim is received. And in case of the joint development agreement, your transfers took place in the year in which possession is handed over to builder, but tax will be paid in the year in which CC is received by the builder. You got my point or not? Yes. Now next part is related to section 45(3) and 45(4). There are two small sections. 45(3) is saying that whenever any partner transfer asset to partnership firm or member transfer asset to AOP BOI, in that case it is treated as transfer and capital gain is applicable. Means partner transfer asset to partnership firm as a capital contribution or otherwise, in that case capital gain is applicable in hands of the partner. What will be the full value of consideration here? So they are saying that in hands of the partner, full value of consideration will be the amount recorded in books of partnership firm. So whatever amount recorded in books of partnership firm, that will be treated as full value of consideration for partner. Now next section is 45(4). 45(4) is saying that whenever partner, whenever partnership firm transfer asset to partner on retirement or on a retirement or at any time, partnership firm transfer asset to the partner or AOP BOI transfer asset to the member, in that case capital gain is applicable in hands of the partnership firm or AOP BOI. What will be the full value of consideration? FMV as on date of transfer. Whatever FMV as on date of transfer, that will be treated as full value of consideration. Now next part is related to 45 subsection 2A, that is related to your demat security. So suppose if any person is having the demat account and he purchased some security and sells some security, then how you will determine that which security is basically transferred? So you have to follow the FIFO method, means first in first out method you have to follow for the purpose of computation of capital gain or identifying the security. Next part is section 50C. 50C is very interesting section that is related to the stamp duty value. Now all people please pay attention. Lawmaker is saying that if any person is having the immovable property means land, building or land and building, and if any person is having immovable property and that immovable property is held as capital asset, and if you transfer that immovable property and SDV of that property is more than consideration by 105%, means SDV is more than 105% of consideration, in that case your SDV will be treated as full value of consideration. What I am saying that if you transfer the immovable property and your stamp duty value is more than 105% of consideration, in that case your SDV will be treated as the full value of consideration. Suppose if assessee is not satisfied with the SDV, then he may request to the assessing officer, and assessing officer may transfer your case to valuation officer. Suppose valuation officer determine the value and that value is more than the stamp duty value. Valuation officer value is more than the stamp duty value. In that case, valuation officer value will be ignored. But suppose valuation officer value is less than the stamp duty value. In that case, whatever value determined by valuation officer, that will be treated as the full value of consideration. You got my point or not? Yes. Now, all people, please pay attention. You have to consider the SDV, that is the stamp duty value. But the stamp duty value of which date basically? Date of agreement or date of registration? Normally, stamp duty value, you have to be considered on the date of registration. You have to opt the SDV on the date of registration, but there are exceptions. All people, please pay attention. What I am saying that SDV you have to take or consider or opt on the date of registration. But if date of registration and date of agreement are not same, if date of agreement and date of registration are not same, then you can take the SDV on the date of agreement if you received any consideration or part thereof up to the date of agreement by account pay check, account pay demand draft, any mode of electronic clearing system through bank account or any other electronic mode as may be prescribed. What I am saying that all people please pay attention. SDV normally you have to take on the date of registration. But if date of registration and date of agreement are not same, then you can take the SDV on the date of agreement also. If you receive any consideration or part thereof means even if you receive the 1 rupees up to the date of agreement by account pay check, account pay demand draft, any mode of electronic clearing system through bank account or any other electronic mode as may be prescribed, then you can take the SDV on the date of agreement. Now, what is the any other electronic mode as may be prescribed? So they prescribe some electronic mode, but now try to understand this electronic mode prescription. This notification is dated 29 January 2020, so it is not applicable for July examination. It is not applicable for July examination, but it will be applicable for the November examination. So what is the notified mode? That is credit card, debit card, net banking, IMPS, UPI, RTGS, NEFT and Bhim, that is Bharat Interface for Money, that is Aadhaar Pay, yeah, you can say that the Bhim. And this notified mode is applicable for above section also, like this section also, that is 13A, 35AD, 40A, 43, 43CA, 44AD, 5680, JJAA, 269 SST, ST and T. Means this mode or notified mode is applicable for that particular section also. You got my point or not? Yes. Now next section is section 50CA. 50CA is saying that if you transfer any unquoted share means, for your understanding, just remember the unlisted share. If you transfer the unquoted share and selling price is less than FMV, then FMV will be treated as the full value of consideration. What I am saying that if you transfer the unquoted or unlisted share and your FMV is more than the consideration, in that case that FMV will be treated as your full value of consideration. Next section is section 50D. Many times, suppose if consideration is not determinable, if you transfer some asset and consideration is not determinable, I can take one example. Suppose I transfer the some gold to you, and you are saying that, sir, we will give you the treat. Means treat is a consideration here. So question is that treat value, like consideration, is determinable? Answer is no, it is not determinable. In that case, whatever asset transferred, means whatever asset you are going to transfer, FMV of that asset will be treated as the full value of consideration. So what is the normally consideration? Means whatever something you received in return, value of that thing is treated as consideration. But if consideration is not determinable, then whatever transferred asset fair market value, that will be treated as the full value of consideration. Now next section is section 51, that is advance money forfeited, or you can say token money forfeited, और पैसा आपने खा लिया करके, ठीक है. तो अगर एडवांस मनी फॉरफिट आपने किया, so if any advance money forfeited, what will be the, suppose sale transaction is not materialized and advance money forfeited, what will be the tax treatment? So you just have to remember, if advance money forfeited before 1/4/2014, advance money forfeited before 1/4/2014, that you have to reduce from your cost of acquisition. Suppose advance money forfeited before 1/4/2014, then whenever you will transfer that asset, you just have to reduce from cost of acquisition. Sir, before indexation or after indexation, you have to reduce before indexation and after you can do the indexation. Means first you have to reduce and after that do the indexation. You got my point or not? Yes. Now try to understand one more thing. This advance money forfeited by the present owner, then only it has to be reduced. Suppose I can take one example. I purchase one property I forfeited some amount before 1/4/2014, and after that I gifted to my wife, and my wife is going to sell the property. Whatever amount forfeited by BB sir, that will not be reduced. Means here only advance money forfeited by present owner before 1/4/2014 you have to reduce from cost of acquisition. You got my point or not? Yes. Now next part, if any advance money forfeited is on or after 1/4/2014, then it will be taxable under income from other sources under section 56(2)(9). So advance money forfeited on or after 1/4/2014 will be taxable under income from other sources under section 56(2)(9). You got my point or not? Yes. Now next part is section 50B, that is the slum sale. What is the meaning of slum sale? Slum sale means sale of undertaking or unit of some business or segment of some business for a lump sum consideration without assigning value of individual asset and liability. Means there is no assignment of individual asset and liability value. Means you transfer any undertaking or segment or part of that undertaking for a lump sum consideration, then this section is applicable. Now in case of slum sale, treat that particular undertaking or part or segment as a one asset and calculate the capital gain. What will be the full value of consideration? Just take the whatever lump sum consideration that is treated as full value of consideration minus transfer expenses, cost of acquisition. What will be the cost of acquisition? So in this case, your cost of acquisition will be the net worth of that particular transferred undertaking. You can say that net worth will be the treated as cost of acquisition. How you will calculate the net worth? So net worth means asset minus liability. For asset, there are two kind of asset. One is a depreciable asset, non-depreciable asset. For depreciable asset, you have to take the WDV as per the Income Tax Act. For depreciable asset, you have to take the WDV as per Income Tax Act, and for non-depreciable asset, just take the book value, and liability you have to reduce at book value. You will get your net worth. Now try to understand here. If your asset is revalued even before 10 years, 6 years, 5 years, 2 years, you have to remove the effect of the revaluation. Means revaluation effect you have to be removed. Now try to understand whatever net worth, that net worth will be treated as a cost of acquisition, but here also index benefit is not available. Here also index benefit is not available. Even that now question is that like in this case, there will be a long-term or short-term capital asset that depends on the undertaking. If that undertaking is held for more than 3 years, then there will be a long-term capital gain, and if that undertaking is not held for more than 3 years, then there will be a short-term capital gain. Even there is a long-term capital gain, then also indexation benefit is not available. You got my point or not? Yes. So I can say that, I can summarize that there are 4 cases where there can be a long-term capital gain, but index benefit is not available. First is that the first proviso to section 48, non-resident taxation and conversion and all that. Index benefit is not available. Second is a debenture and bonds. In case of debenture and bonds, index benefit is not available. Third is the section 112A. If section 112A is applicable, then index benefit is not available. And fourth is a slum sale. In case of slum sale, index benefit is not available. Now we are going to start with the section 47. There are certain transactions that is not treated as transfer. So there are certain transactions are not treated as transfer, or I can say that the exempt transfer. If you undertake this transaction, then capital gain is not applicable. First, there is a partition on the there is a distribution of asset on the partition of HUF. If HUF is a partition took place, there may be a partial or total partition of HUF. Nowadays, only total partition is there in the Income Tax Act. So if there is a partition of HUF and asset is distributed to member, then it is not treated as transfer. Capital gain is not applicable. Second is a gift, will, or irrevocable trust. If you transfer any asset under the gift, then it is not treated as transfer. Capital gain is not applicable, but there is one exception. If you gift any share or security which is received under ESOP, if any person received share as security as a ESOP, and if he gift that asset to someone, then capital gain is applicable. But question is that what will be the full value of consideration here? FMV as on the date on FMV as on the gift date. Whenever you gift that asset or ESOP, FMV as on that date will be treated as your full value of consideration. You got my point or not? All people, please pay attention. What I am saying that gift is not treated as transfer, capital gain is not applicable, but there is one exception. There is one exception. If you receive any share under the ESOP and if you gifting that share to someone else, in that case, on the date of gift, whatever FMV, that will be treated as full value of consideration and capital gain is applicable. Third, in case of amalgamation, if amalgamating company transfer asset to amalgamated company, then it is not treated as transfer. Capital gain is not applicable. Condition is that amalgamated company, or I can say that new company should be a Indian company. Now, fourth and fifth condition. Fourth and fifth is saying that In case of holding to subsidiary, if holding company transfer asset to subsidiary company or subsidiary company transfer asset to holding company, then capital gain is not applicable. There are two conditions. First condition is that holding company should hold entire share capital of subsidiary company, means 100% share of subsidiary company should be held by the holding company. And second condition is that transferee company should be the Indian company. So basically there are five transactions are not treated as transfer. First is the HUF partition, second is a gift, third is the amalgamation, fourth is a holding to subsidiary, and subsidiary to holding. It is not treated as transfer, capital gain is not applicable. Now try to understand. Suppose I gift some asset to like some person or my relative or any person. It is not treated as transfer, capital gain is not applicable. But suppose that transferee again transfer that asset to someone, then capital gain will be applicable. But what will be the cost of acquisition? Cost of acquisition will be the cost to the previous owner as per section 49 subsection 1. Period of holding is also from previous owner, and index benefit is also from previous owner as per the case law of the Manjula J. Shah. So if you received any asset due to the section 47 mode and capital gain was not applicable in hands of earlier transfer, in case of the earlier transfer, in that case cost of acquisition, cost to the previous owner, period of holding is also from previous owner, and indexation is also from previous owner. You got my point or not? Yes. Now try to understand one more thing. In case of holding subsidiary, if holding company transfer asset to 100% subsidiary or subsidiary company transfer asset to holding company, capital gain is not applicable. Transfer is not, it is not treated as transfer. But there is one section 47A, and 47A is saying that all people please pay attention. All people that transfer is not treated as transfer, capital gain is not applicable. But now try to understand, there are two conditions. Okay, within 8 years from the date of transfer, within 8 years from the date of transfer, the transferee company should not convert that asset into stock in trade, and there should be 100% holding subsidiary relationship for 8 years. What I am saying that all people please pay attention. Holding subsidiary holding, it is not treated as transfer, capital gain is not applicable, but there is restriction due to section 47A. 47A is saying that for 8 years from the date of transfer, that transferee company should not convert that asset into stock in trade. And second, that 100% holding subsidiary relationship should be exist for 8 years. If there is a violation, means either convert into stock in trade or cease to be hold 100% share capital, then whatever capital gain exempt earlier in hands of transfer company, now that will be taxable. Means exemption claim earlier by transfer company, that will be withdrawn and it will be taxable. Now it will be like exemption will be withdrawn and it will be taxable in hands of transfer company in the year in which original transfer took place. Means suppose transfer was took place 2 years ago, and now in this year that condition is violated, then in original year, means 2 years ago, we will calculate the capital gain, we will rectify the return of the transfer company, and in case of transfer company, now capital gain will be applicable, and capital gain is applicable only in the year in which original transfer took place. Means we have to rectify the return of the transfer company. You can say that. Oh, you got my point or not? Yes. Now next part is related to, suppose you are the shareholder of the next part, that next condition, next exempt transfer is section point number 6, and point number 6 is saying that suppose if there is an amalgamation of the two foreign company, if there is an amalgamation of two foreign company and one foreign company is transferring shares to another foreign company, and that is the Indian company share. What I am saying that all people please pay attention. There are two foreign company. One name is a Limited. Suppose one name is a A Limited and one is the B Limited. One is the A Limited, one is the B Limited. Both are foreign company. Okay? Both are foreign company. Now what happened? A Limited is holding shares of the Reliance Industries Limited. A Limited is holding share of the Reliance Industries Limited, and Reliance Industries Limited is an Indian company. Now what happened? A Limited is merged with the B Limited. Means A Limited is an amalgamating company, B Limited is amalgamated company. So in amalgamation, A Limited transferring share of Reliance to the B Limited, in that case it will not be treated as transfer. Capital gain is not applicable if two conditions are satisfied. First condition is that whatever shareholder of A Limited, at least 25% shareholder of A Limited should become the shareholder of the B Limited. And second condition is that there should be no tax in the country in which A Limited is incorporated. Means in the country in which A Limited is incorporated, in that country also there is that transaction should not be like a preview under the taxation, means it should be exempt transfer or exempt transaction in the country in which A Limited is incorporated. You got my point or not? Yes, all people. Next part is related to, okay, if there is an amalgamation of banking company with the banking institution, like suppose Punjab National Bank is merged with the SBI, in that case also it is not treated as transfer, capital gain is not applicable. Now try to understand one more thing. Okay, suppose there are two foreign company, name is A Limited, B Limited, both are foreign company. And there is one more company, name is a C Limited, that C Limited is also a foreign company. That C Limited is also a foreign company, and C Limited shares derive its value from Indian asset as per section 9 in the international taxation. That C Limited share is derived its value, C Limited share is derived its value from Indian asset. In that case, suppose A Limited transfer the shares to B Limited of the C Limited, capital gain is not applicable. It is not treated as transfer. There are two conditions, same condition. 25% shareholder should become the shareholder of the B Limited, and that transaction should be tax free in the country in which A Limited is incorporated. You got my point or not? Yes. Now try to understand one more thing. Suppose you are a shareholder of one company, Sai Limited, and Sai Limited is merged with the Shirdi Limited, then you are going to get the share of Shirdi Limited in exchange of share of Sai Limited. It is also not treated as transfer, capital gain is not applicable. So suppose if shareholder receive the share of the new company instead of the share of old company due to the amalgamation, it is not treated as transfer, capital gain is not applicable. But condition is that amalgamated company should be the Indian company, and consideration of the allotment to him in the share in the amalgamated company, means you are going to get only share in the amalgamated company, then only it is not treated as transfer. Now try to understand, in India, demerger is also tax free. If there is a demerger of any company, demerger means like one company is demerged and they make the another company. Suppose I always take one example of the Titan Limited. Titan Limited is having the two segment. One is the jewelry segment, one is the watch segment. Suppose jewelry segment is a Tanishq. They like demerged that Tanishq and they made the one company, that is Tanishq Limited. It is treated as the demerger. In case of demerger, whenever your demerged company transfer asset to resulting company, it is not treated as transfer, capital gain is not applicable. All you got my point or not? Yes. Now suppose there is a demerger of the foreign company, and due to that demerger, Indian company share is transferred to resulting company, then also it is not treated as transfer, capital gain is not applicable. But there are two conditions. First condition, demerged company 75% shareholder of the demerged company should become the shareholder of resulting company, and there should not be a tax in the country in which a demerged company is incorporated. Or suppose I can take one example, there is a demerger of two foreign company, there is a demerger of foreign company, and that foreign company is having share of another foreign company, and that another foreign company derive its value substantially from Indian asset, and that foreign company share is transferred under demerger, then also capital gain is not applicable. Same condition, 75% shareholder of demerged company should become the shareholder of resulting company, and there should be no tax in the country in which demerged company is incorporated. You got my point or not? Yes. Now suppose if you receive the share under demerger of the resulting company, then it is not treated as transfer, capital gain is not applicable. You got my point or not? Yes. Now next part is related to all people, please pay attention. Suppose if there is any non-resident, and non-resident transfer bonds or GDR of Indian company to another non-resident outside India, it is not treated as transfer, capital gain is not applicable. What I am saying, all people, please pay attention. If one non-resident transfer the bonds or GDR of Indian company notified under section 115 AC to another non-resident outside India, then capital gain is not applicable. Next point is saying that if non-resident transfer to another non-resident rupee denominated bonds of Indian company outside India, then also capital gain is not applicable. And next point is a point number 17. First remember the point number 17. If one non-resident transfer the government security, and on that government security he is going to get the periodical payment of interest, means government bonds, government debenture and all. So one non-resident transfer the government security to another non-resident outside India, means out of India, then also it is not treated as transfer, capital gain is not applicable. So all people, please pay attention. There are three transactions. First point is saying that if bonds or GDR of Indian company, rupee denominated bonds or government security transfer by one non-resident to the another non-resident outside India, it is not treated as transfer, capital gain is not applicable. Now try to understand one more thing. If any non-resident transfer the bonds or GDR or derivatives or RDB, rupee denominated bonds, or any other security as may be notified in the recognized stock exchange of the IFSC, that is International Financial Service Center. India's first IFSC is located in Gandhinagar, that is near to Ahmedabad. So if he transfer the four assets. One is the bonds or GDR referred under section 115 AC or rupee denominated bonds of Indian company or any other security notified or derivative. In the IFSC, recognized stock exchange of IFSC, in that case it is not treated as transfer, capital gain is not applicable. Condition is that consideration should be received in the convertible foreign currency. So all people please pay attention. What I am saying that, okay, if there is a non-resident transferring the four assets, first is the bonds or GDR of Indian company, rupee denominated bonds, derivative or such other security as may be notified in the recognized stock exchange located in IFSC and consideration is received in foreign currency, then capital gain is not applicable. Now there are certain notified security. Now what is the notified security? There is a new notification. This notification is not applicable for July 2020 examination, but it is applicable for the November 2020 examination. So there are basically some security they notified, that is foreign currency denominated bonds, units of mutual fund, units of business trust, foreign currency denominated equity share of company or units of alternative investment funds. So basically there are 5 notified security. If this security or RDB of Indian company or derivative or bonds or GDR of Indian company, if it is transferred in IFSC recognized stock exchange by non-resident and consideration is received in foreign currency, then capital gain is not applicable. You got my point or not? Yes. Now try to understand in case of the sovereign gold bond issued by the RBI, sovereign gold bond issue by the RBI, and if there is a redemption and in case of individual, then it is not treated as transfer, capital gain is not applicable. I already explained you earlier. Okay, in case of the sovereign gold bond, if at the time of redemption, capital gain is not applicable if assessee is an individual. Now try to understand this painting and drawing, painting, sculpture, it is treated as capital asset. Capital gain is applicable. But suppose if that drawing, painting and books and all, if you transfer this asset to the government or National Art Gallery or National Museum or National Archive, in that case, or any public museum or any notified institution, then it is not treated as transfer, capital gain is not applicable. You got my point or not? Yes. All people now please pay attention. If there is any debenture, bonds, debenture stock or deposit certificate of any company, and that debenture, bonds, deposit certificate or debenture stock of that company is converted into share or a debenture of that company, then that conversion is not treated as transfer, capital gain is not applicable. Suppose I am having the bonds of the Tisco and Tisco bond is converted into the equity share of Tisco today, then at the time of conversion it is not treated as transfer, capital gain is not applicable. But whenever you will transfer that share, then capital gain is applicable. Answer is yes. Period of holding you will take from the date on which debenture stock, deposit certificate is acquired, and indexation is also available from the date on which that debenture stock or deposit certificate is acquired. You got my point or not? Yes. So what I am saying that, okay, if you are having the debenture, bonds, deposit certificate or debenture stock and that is converted into debenture and share, debenture or share of that company, at the time of conversion it is not treated as transfer, capital gain is not applicable. But whenever you will transfer that share or new debenture, then capital gain is applicable. Cost of acquisition, you have to take the cost of acquisition of that earlier asset, and period of holding is also from the date of acquisition of earlier asset. Next part is related to conversion of preference share into equity share. Suppose if you are having preference share of any company and that preference share is converted into equity share, it is not treated as transfer. But whenever you will transfer the equity share, that type capital gain is applicable. What will be the cost of acquisition? Cost of acquisition of preference share. Period of holding is also from the date of acquisition of preference share, and indexation is also from the date of acquisition of preference share. You got my point or not? Yes. Now try to understand if there is any sick industrial company and sick industrial company transfer any land, then it is not treated as transfer, capital gain is not applicable. Sick industrial company transfer any land, then it is not treated as transfer, capital gain is not applicable. Now try to understand one more thing. All people, I already explained you, like BSC Limited, NSC Limited earlier were the AOP BOI, now it is a company. So in BSC and NSC, if any person was the member and he was holding the membership card and that membership card is transferred in exchange of the shares of BSC, NSC, and he is going to receive the trading and clearing right, it is not treated as transfer, capital gain is not applicable. But whenever he will transfer the share of that BSC, NSC, then cost of acquisition of original membership card will be treated as cost of acquisition, and period of holding will also from the date on which original membership of that stock exchange was acquired. You got my point or not? Yes. Next part is related to stock lending scheme. Suppose if any person lend the stock, means share and security, is lending for some time to other person, then a stock lending scheme is not treated as transfer, capital gain is not applicable. In case of reverse mortgage scheme is applicable for basically for senior citizens. So in case of the reverse mortgage scheme, In case of reverse mortgage scheme, whenever senior citizen died or expire, that time if asset is transferred to bank, in that case it is not treated as transfer, capital gain is not applicable. So in case of the reverse mortgage scheme, it is not treated as transfer, capital gain is not applicable. And try to understand, whenever he receive any consideration under reverse mortgage scheme, that consideration is also totally exempt due to section 10. So if you received any consideration under reverse mortgage scheme, that is totally exempt. And reverse mortgage scheme, whenever you transfer the asset under reverse mortgage scheme, it is not treated as transfer, capital gain is not applicable. Now next part is related to the succession or succession. There are basically three kind of succession or conversion of business, and that three kind of succession or conversion of business is totally exempt. Capital gain is not applicable. First point, all people please pay attention. If any partnership firm is converted into company, if there were any partnership firm and that partnership firm is converted into company, it is not treated as transfer, capital gain is not applicable if four conditions are satisfied. First condition, all asset and liability of partnership firm should be transferred to company. Second, all partner of partnership firm should become the shareholder of company, and they are going to receive the share of that company in the proportion in which their capital account were stored in the partnership firm. So whatever capital account ratio, in the same ratio they are going to get the share from the company. Third condition, that partner should receive only share of the company. And fourth condition, that partner should have the equity shareholding or voting power shareholding for at least 5 years. That should not be below the 50%, means 50% or more equity shares should be held by that partner for next 5 years from the date of the conversion. You got my point or not? All people please pay attention. So what I am saying, that if partnership firm is converted into company, it is not treated as transfer, capital gain is not applicable. There are four conditions. First condition, all asset and liability transfer, all partners should become the shareholder in the same ratio in which capital account was stored, and partners should receive only shares from the company, and partners should be hold at least 50% or more equity share for next 5 years. You got my point or not? Yes. Next part, if any proprietary concern is converted into company. So if any proprietary concern is converted into company, it is not treated as transfer, capital gain is not applicable, but condition is that, first condition, that all asset and liability should be transferred. Second condition, that proprietor should become the shareholder obviously, and proprietor should receive only shares from that company, and proprietor equity shareholding in that company should not be less than 50% for next 5 years, means next 5 years he should hold at least 50% or more equity share in that particular company. Now next part is related to, if there is a company that is small company, and company is converted into LLP, then also capital gain is not applicable. What I am saying, that company is converted into LLP, then also capital gain is not applicable, but there are basically 7-8 conditions. First condition is that all asset and liability should be transferred. Second condition, that all shareholder of company should become partner of that LLP, and in case of LLP, their PSR and capital in LLP should be in the same ratio in which their capital was there in that particular company. Third condition, like shareholders should receive only PSR and capital in LLP. Fourth condition is that shareholder should be hold at least 50% or more PSR in that LLP for next 5 years from the date of conversion. Means for next 5 years, they should hold at least 50% or more PSR in that LLP. Now there are 3 extra conditions. First condition is that turnover of that company in the last 3 previous years should not be more than the 60 lakh. Means up to 60 lakh, means last 3 year turnover of that company should be up to 60 lakh. One more condition, in the last 3 years, their total asset as per balance sheet should not be more than 5 crore. And last condition is that from the date of conversion, within 3 years after the date of conversion, that LLP should not distribute accumulated profit to the partner. Means whatever accumulated profit on the date of conversion, that accumulated profit should not be distributed to the partner within 3 years after the date of conversion. You got my point or not? Yes. Suppose in this 3 succession case, if any condition is violated, then whatever capital gain exempted earlier shall be taxable in the year in which violation took place, shall be taxable in the year in which violation took place in hands of the successor, because you know that there is no predecessor, because predecessor is already, their business is already discontinued and all, and now there is a new assessee, or I can say that the successor. So in the year of succession, whatever capital gain exempted earlier due to section 47, that will be taxable in hands of the successor. You got my point or not? Yes. Now all people please pay attention. Next part is related to there is a merger of basically schemes. Many times, you know that in Kotak Mahindra Mutual Fund and all, there are lots of schemes. So lawmaker is saying that do one thing, please merge similar scheme. So suppose I can take one example. I am having the unit of scheme A, and Kotak Mahindra Mutual Fund is going to merge scheme A with the B. So I am going to get the scheme B unit in exchange of scheme A unit. So it will be treated as transfer or not. So lawmaker is saying that suppose you are going to get the units of new unit due to the merger of a unit, in that case it is not treated as transfer, capital gain is not applicable. But what will be the cost of acquisition? So suppose I received the unit B in exchange of unit A, then whatever cost of acquisition of my unit A, that will be treated as my cost of acquisition of unit B. Period of holding will be from the date on which unit A was acquired, and period of holding is cost of acquisition is also cost of acquisition, period of holding, and indexation is also from the date on which unit A A unit is acquired. You got my point or not? Yes. But this exemption at the time of merger, this exemption is available only if one equity oriented unit merge with another equity oriented unit, or debt oriented unit is merged with the debt oriented unit, then only that exemption is available. Now try to understand next and last part is related to the merger of plan. There are various plan of mutual fund, like dividend plan, growth plan and all. So suppose if there is one scheme and a scheme is having various plan and there is a merger of plan and you are going to get the unit of new plan, then also capital gain is not applicable. But what will be the cost of acquisition of that unit? Whatever cost of acquisition of your unit of your old plan. Period of holding is also from old plan and indexation is also from old plan. You got my point or not? Yes. So this is the completion of your exemption under section 47. Now we are going to revise some important exemptions. So exemption under section 54, first section, section 54. 54 is applicable only in case of individual and HUF. It is applicable when you transfer the residential house property. So lawmaker is saying that if any individual and HUF, if he transfer any residential house property and if he going to acquire the one residential house property in India, then whatever capital gain on earlier house property, that will be exempt. All people please pay attention. This section is applicable for residential house property if any individual and HUF transfer residential house property and he is going to acquire the one residential house property, then exemption is available. Now question is that suppose if that individual HUF acquired the two residential house property, then exemption is available or not? Answer is no, but there is an amendment from this year. And amendment is saying that suppose if there is a long-term capital gain on that old house property, long-term capital gain on old house property is up to 2 crore, then assessee can acquire the two residential house property and he can get the benefit of the exemption on two residential house property. But condition is that capital gain, that LTCG should be up to 2 crore and this benefit is available only once in the lifetime. Means two house property acquisition, this benefit is available only once in the lifetime. Now try to understand what is the time limit to acquire the another or new residential house property. Time limit is -1 +2 +3. Means new house property should be purchased within 1 year before the date of transfer, or purchased within 2 years after the date of transfer, or constructed within 3 years after the date of transfer. Means construction should be completed within 3 years after the date of transfer. Now question is that is there is any time restriction or time limit to start the construction? Answer is no. It can be start 5-6 years ago also, but it should be completed within 3 years after the date of transfer, then exemption is available. You got my point or not? Yes. Now what will be the now lawmaker is saying that time limit is 1 year, 2 year and 3 year, -1 +2 +3. But up to the due date of return filing, means whatever up to the due date of return filing, either assessee has to acquire that property or deposit that amount in the CGS scheme, that is capital gain account scheme, and out of that amount he should acquire that amount only for the purpose of house property. If there is any misutilization or unutilization, then whatever exemption claim earlier shall be withdrawn in the year of misutilization or unutilization and it will be treated as the LTCG. You got my point or not? Yes. And in case of unutilization, it will be taxable in the year in which that 3 year is expired. So whenever the 3 year expire, in that year it will be taxable as LTCG. You got my point or not? Yes. Now what will be the amount of exemption? Amount of exemption will be whatever your capital gain amount and cost of new asset or deposit amount, whichever is lower. Cost of capital gain amount and cost of new asset or deposit amount, whichever is lower is treated as your exemption amount. Now try to understand. There is a lock-in or restriction on transfer of new house property for 3 years. Means whatever new house property you acquired, that should not be transferred within 3 years. That should not be transferred. Means that new asset should not be transferred within 3 years. Suppose if you transfer within 3 years, then what will happen? So whenever you will transfer, suppose asset is transferred within 3 years, then whenever you will calculate the capital gain on new asset, then how you will calculate the capital gain? First take the full value of consideration minus transfer expense, cost of acquisition. Whatever exemption you claim earlier, that exemption will be reduced from the cost of acquisition of that new house property. Whatever exemption claim earlier, that will be reduced from cost of acquisition of that new house property. You got my point or not? Yes. So this is the section 54. Now 54B, 54D, you have to like revise in homework. Next section is section 54EC. 54C EC is related to if assessee acquired the NHI, RECL, PFCL or IRFCL bond within 6 months, then exemption is available. This exemption is available to all assessee, means individual, HUF, company, partnership, from all assessee. If assessee transfer the immovable property, that is land, building or both, and if they acquire the NHI, RECL, PFCL or IRFCL bond, then exemption is available. If they transfer any asset, if they transfer the immovable property, there is a long-term capital gain, and they acquire the NHI, RECL, PFCL or IRFCL bond within 6 months from the date of transfer, then exemption is available. But try to understand, in this section, you can claim the maximum exemption of 50 lakh rupees. In one previous year, you can claim the maximum exemption of 50 lakh rupees. So whatever bond you acquire within 6 months, you can take the maximum exemption of 50 lakh rupees. You got my point or not? Yes. Now try to understand, there is a capital gain account scheme, CGS scheme is not applicable in this section, but there is a restriction of 5 years. Means whatever bond you acquire, you should not be transfer that bond within 5 years, as well as you cannot convert that bond into money. Now question is that what is the meaning of conversion into money? Conversion into money means you cannot take loan against the mortgage of this bonds. Means you cannot mortgage this bond and you take the loan and all that thing. Suppose if it is transferred within 5 years or it is converted into money, means you took the loan against the mortgage of this bond, then whatever exemption claim earlier shall be withdrawn and treated as long-term capital gain in the year in which that violation took place. Now next part is related to section 54F. 54F is saying that, first thing, this section is applicable only to individual and HUF. If you transfer any LTCA other than residential house property, but you are going to acquire the one residential house property in India, then exemption is available. Means individual HUF transfer any long-term capital asset, acquire the one residential house property in India, exemption is available. Here, what is the time limit? Time limit is same, -1 +2 +3. Capital gain account scheme same, but what is the amount of exemption? Here, amount of exemption is little bit different. Now try to understand how you will get the amount of exemption. So suppose if your net consideration is fully utilized, whatever the net consideration of old asset, if net consideration is fully utilized, then capital gain is fully exempt, but net consideration is partly utilized, then capital gain is partly exempt. How partly exempt? First, take the LTCG multiply by cost of new asset divided by net consideration. LTCG multiply by cost of new asset divided by net consideration. So it is exempt proportionately, or you can say that partly. Now try to understand, there is a restriction on transfer of the new asset for 3 years. Means whatever new house property you acquire, it should not be transferred within 3 years. Suppose if you transfer within 3 years, then calculate capital gain normally on new house property. Means capital gain calculation normally or as usually on the new house property, and whatever exemption claim earlier under section 54F, that will be treated as LTCG in the year in which new house property is transferred. You got my point or not? Yes. Now try to understand, there is one more condition under this section. Under this section, exemption cannot be claimed if assessee is already having more than one house property. Suppose if assessee is already having 0 house property or 1 house property, he can claim the 54F exemption. But suppose if assessee is already holding more than 1 house property on the date of transfer of any other asset, in that case, exemption under this section is not available. And one more point, all people please pay attention. Assessee cannot purchase any other house property within 2 years after the date of transfer. Means assessee can purchase only one house property under this section. Assessee cannot purchase any other house property within 2 years after the date of transfer. If he purchase, then whatever exemption claim earlier shall be withdrawn and treated as the LTCG. Now next part, 54G and GA is a homework. 54GB I am going to revise. All people please pay attention. 54GB is saying that suppose if any individual and HUF, this section is applicable only to individual and HUF. Individual and HUF is having immovable property. In immovable property, only residential house property or residential plot of land. Individual HUF, this section is applicable to individual and HUF. Individual HUF is having residential house property or plot of land, and suppose if he transferred that residential house property or plot of land and there is a long-term capital gain. and assessee have to acquire the share of newly incorporated startup. Means assessee, what assessee has to acquire? Assessee has to acquire the share of the newly incorporated startup, and that startup will acquire new plant and machinery. Then exemption is available to individual and HUF. What I am saying, that all people please pay attention. What I am saying, assessee is an individual HUF. He transferred the residential house property or plot of land, and there is a long-term capital gain on that asset. He has to acquire the equity share of the newly incorporated startup, and that startup will acquire the new plant and machinery. Then capital gain is exempt in hands of this individual and HUF. Now try to understand one thing. Sir, what is the time limit to acquire the share? So here time limit is that individual HUF has to acquire the equity share of newly incorporated startup up to the due date of return filing of that assessee, and that company should acquire the new plant and machinery within 1 year from the date of subscription of share by individual HUF. So assessee has to acquire the equity share of a startup up to the due date of return filing of that assessee or individual HUF, I can say that. And that company should acquire the new plant and machinery within 1 year from the date of subscription of share by individual and HUF. You got my point or not? Yes. Now how you will, what will be the exemption amount? Exemption amount will be similar to section 54F. If net consideration is fully utilized in plant and machinery, then capital gain is fully exemption, otherwise proportionate. That is LTCG multiplied by cost of new asset में plant and machinery divided by net consideration. You got my point or not? Yes. Now try to understand one more thing. Now question is that, sir, is that CGS, capital gain account scheme, is applicable to assessee? Answer is no. For individual and HUF, that CGS scheme is not applicable, because individual and HUF has to acquire that equity share up to the due date of return filing. But for company, that new startup company, that CGS scheme is applicable. Means that company should acquire the new plant and machinery up to the due date of return filing of assessee, or that company should deposit that amount in the CGS account up to the due date of return filing of assessee. Then assessee can claim the exemption under section 54 GB. You got my point or not? Yes. Now next part, all people please pay attention. That assessee, that is individual and HUF, should not transfer that share within 5 years from the date of acquisition. Means individual HUF, that assessee means individual HUF. Always I will say startup, that is a company. Okay? So individual HUF should not transfer that share within 5 years from the date of acquisition. If it is transfer the share within 5 years, then capital gain on share will be calculated separately, and whatever exemption claim earlier shall be treated as long-term capital gain in hands of assessee in the year in which he transferred the shares. Now try to understand, there is one more restriction, and that restriction is saying that that startup company should not transfer the new plant and machinery within 5 years from the date of its acquisition. Means that company should not transfer the new plant and machinery within 5 years from the date of its acquisition. Means company should not transfer the plant and machinery within 5 years from the date of its acquisition. If it is transferred within 5 years, then capital gain on plant and machinery will be taxable in hands of company. But whatever exemption claim earlier by individual and HUF, that will be treated as LTCG in the year in which company transfer the plant and machinery. You got my point or not? Yes. But try to understand, for computer and computer software, and if a startup like in a computer and computer software, that restriction is not of 5 years, that restriction is applicable only for 3 years. So normally plant and machinery, other plant and machinery 5 years, but in case of the eligible startup, if computer and computer software, then obviously that time limit is 3 years. The restriction is lock-in is applicable only for 3 years, because there is a technology development and all. So within 3 years, it should not be transferred. You got my point or not? Yes. Now what do you mean by the company? Company means, first condition, that company should be new. Means company should be incorporated between 1st April of previous year till the due date of return filing of that previous year. Second condition is that company should be engaged in eligible business. Third condition is that assessee, individual HUF, should hold at least 25% share, or voting power of that company. And last condition is that company should be treated as the eligible startup. Now question is that eligible business means business of the innovation, development or improvement of product, process and service, or a scalable business model with the high potential of the employment generation and wealth creation. Obviously there is no need to remember the definition. Eligible startup means incorporated between 1st April 2016 till 1st April 2021. Turnover of that company in the year in which 80 IAC deduction is claimed, that should not be more than the 25 crore. And third condition is that a startup should hold the certificate of eligible startup as from the IMBC, that is the Inter-Ministerial Board of Certification. Now try to understand here, new asset means whenever that company acquired the new plant and machinery. So new plant and machinery means it should not be a second hand. Plant and machinery will not include the any plant and machinery installed in office premises or residential accommodation, or computer software, or vehicle, or plant and machinery on which 100% deduction is claimed. Now you are saying that, sir, you are you may ask us, sir, you are saying that computer software is not included in the definition of plant and machinery, but for the startup, technology driven startup, that computer software is an essential part of the business. So here lawmaker is saying that don't worry about that. In case of the eligible startup, and in eligible startup, if there is a technology driven startup and they acquire the computer or computer software, then it will be forming part of your asset. You got my point or not? Yes. Now next section and last section. Exemption, there are two sections basically. One is the 1037. 1037 is saying that in case of individual and HUF, individual and HUF is having any urban agriculture land, and that urban agriculture land was used by that assessee or parents for 2 years before the date of transfer for agriculture purpose, and if there is a compulsory acquisition of that urban agriculture land, then capital gain is not applicable. It is totally exempt. Next section is 1037A. 1037A is basically applicable only for the people located in Amravati in the state of the Andhra Pradesh. You know that after the split of the Andhra Pradesh, the new state is Telangana, and Hyderabad is transferred to the Telangana. So Andhra Pradesh is going to develop the new capital, that is the Amravati. So this section is applicable only for the person located in the Amravati. So lawmaker is saying that all people please pay attention. 1037 is A. This section is saying that if only individual and HUF, this section is only applicable to individual and HUF. Suppose individual and HUF is having any immovable property in the area of Amravati on the 2nd June 2014. Means individual HUF is having immovable property, that is land, building or land and building in the area of Amravati on the 2nd June 2014, and they transfer that immovable property, means individual HUF transfer that immovable property to the government under land pooling scheme, then it is not treated as transfer. Capital gain is not applicable. Here government will issue the LPOC, that is land pooling owner certificate. So immovable property transfer, like individual HUF received the LPOC, capital gain is not applicable, it is exempt. Suppose that individual HUF transfer that LPOC, land pooling ownership certificate, then also capital gain is not applicable. Suppose he not transfer the LPOC, and in exchange of LPOC, government is going to give the possession of developed plot to that individual HUF. So suppose in exchange of LPOC, individual HUF received the developed plot in the area of the Amravati after development of that capital. Then he received the developed plot, and if he transferred that developed plot within 2 years from the end of the year in which possession is received, then also capital gain is not applicable. What I am saying that all people please pay attention. Individual HUF located in the area of Amravati of the Andhra Pradesh under land pooling scheme, if he transfer the immovable property, he received the LPOC, it is not treated as transfer, capital gain is not applicable. If he transfer the LPOC, capital gain is not applicable. If he received the developed plot, and he transferred the developed plot within 2 years from the date, 2 years from the end of the previous year in which possession is received, in that case also capital gain is not applicable. But if he transfer after 2 years, then capital gain is applicable. But now question is that what will be the cost of acquisition? Then cost of acquisition will be the stamp duty value. Stamp duty value at the end of that 2 years. 2 years from the end of the year in which possession is received, end of 2 years, whatever SDV will be there, that will be treated as the cost of acquisition. You got my point or not? Yes. Now we are going to start with the tax rate under the capital gain. So what is the tax rate? Basically, in case of long-term capital gain, tax rate will be 20%. Short-term capital gain, tax rate is a slab rate, or you can say the normal tax rate. But there are certain special tax rate, like long-term capital gain 20%, short-term capital gain like normal tax rate, or you can say slab rate, or 30%. But for share and security, there are some special tax rate. So now we are going to start with the section 112A. Now section 112A. 112A is saying that LTCG, if there is a long-term capital gain on the equity share or equity oriented mutual fund or units of business trust, then that long-term capital gain in excess of 1 lakh will be taxable at the rate 10%. Earlier, there were exempt under section 1038. But this amendment is made by the Finance Act 2018. Lawmaker is saying that all people please pay attention. If there is a long-term capital gain on the equity share or equity-oriented mutual fund units or units of businesses, that will be taxable at the rate 10% in excess of 1 lakh if two conditions are satisfied. First condition, in case of equity share, STT should be paid at the time of purchase as well as sale. Means STT should be paid at the time of acquisition and sale. And in case of the equity-oriented units and units of business trust, STT should be paid at the time of transfer of asset. So if conditions are satisfied, STT is paid. In that case, long-term capital gain in excess of 1 lakh will be taxable at the rate 10%. Now try to understand. In case of the IFSC, IFSC means International Financial Service Center. In IFSC, STT is not applicable. Then also, suppose if any person make the transaction in IFSC, then also he is eligible to get this benefit of 112A or not? Answer is yes. So in case of the IFSC, STT is not applicable. Then also you can get the benefit of section 112A. Now next part, in case of LTCG under section 112A. Deduction under chapter 6A is not available. Deduction under chapter 6A is not available against the LTCG under section 112A. As well as the 87A rebate is also not available. So 87A rebate, that is also not available against the LTCG under section 112A. You got my point or not? Yes. Now try to understand. All people please pay attention. What I am saying that? Okay, in case of equity share, there is a condition that STT should be paid at the time of acquisition as well as at the time of transfer. At the time of acquisition as well as at the time of transfer, but CBDT have the power, and that power is given under this section that CBDT can notify certain transaction, and on that transaction if STT at the time of purchase is not paid, then also is it okay? No problem. Benefit of 112A is applicable. Means there are certain transaction, on those transaction if STT at the time of acquisition is not paid, only paid at the time of the sale, then also benefit of 112A is applicable. And what is this transaction? First, if any share, equity share is acquired before 1st October 2004, because STT was introduced with effect from 1st October 2004. So before 1st October 2004, obviously there was no concept of STT, so there is no question to pay the STT. So if any share is acquired before 1st October 2004 without STT, then you can claim the benefit of 112A. Even STT is not paid at the time of acquisition. Means STT you have to pay only at the time of sale. And second, if any share is acquired on or after 1st October 2004, but STT is not leviable on that transaction. Means share acquired on or after 1st October 2004, but STT is not applicable on that acquisition. In that case also no problem. Pay STT only at the time of sale and you can get the benefit of 112A. But there are three exceptions. Lawmaker is saying that in these three cases, 112A benefit is not available. In these three cases, 112A benefit is not applicable. First is part C. Part C is saying that suppose if there were any listed share, but that company share got delisted, and from the date on which company share got delisted till the date on relisted, means before the date on which share got relisted, between that delisting period, if you acquire any share, then obviously you not paid the STT. Then 112A benefit is not available, even you paid the STT at the time of sale. So what I am saying that in three cases 112A benefit is not available. Basically in three cases 112A benefit is not available. Suppose if you acquire the share in delisting period. Second point is saying that suppose if there is listed equity share, existing listed equity share, and that existing listed equity share is not frequently traded, and you acquired that share through the preferential issue, in that case also 112A benefit is not available. Means if any person acquired the share under the preferential issue, existing listed equity share, but he acquired under the preferential issue, in that case 112A benefit is not available. But there are certain exceptions. If Supreme Court, High Court, NCLT, SEBI or RBI is approved that acquisition, then it is okay, no problem, 112A benefit is available. Or if it is acquired by the non-resident in accordance with the FDI guidelines, then benefit is available. And if it is acquired by the investment fund or qualified institutional buyer, then exemption is available. Then benefit is available. Now next part, all people please pay attention. Suppose if any existing listed equity share is acquired, but that is not acquired through recognized stock exchange. What I am saying that all people please pay attention. Existing listed equity share, but you are acquiring that share not through recognized stock exchange, then 112 benefit is not available, but there are certain exceptions. First exception is that suppose if you acquired that share through issue of share, whenever company issue the share, then obviously first issue will be out of market, out of recognized stock exchange, and after that share will get listed. So suppose if you like share acquired through the issue of share, then it is okay, no problem. Or it is acquired and that is approved by Supreme Court, High Court, NCLT, SEBI, RBI, then it is okay, no problem. Or suppose if you acquired under the ESOP scheme, then it is okay, no problem. Or acquired by non-resident under FDI guidelines, then it is no problem. Acquired from government, then there is no problem. Or acquired under transaction referred under section 47, that is through the gift or slum sale and all. Or it is acquired by the investment fund or qualified institutional buyer, then it is no problem. All people, please pay attention. I am going to explain you again. What I am saying that 112 benefit in case of equity share is applicable only if you paid the STT at the time of acquisition and at the time of transfer. But in case of acquisition, if you not paid the STT, then it is also okay if government notified that transaction. Now try to understand. Government is saying that if any equity share is acquired before 1st October 2004, STT not paid, chalega, no problem at all. Only you have to pay the STT at the time of sale. 112 benefit is available. Or acquired on or after 1st October 2004, but STT is not applicable, then also no problem. 112 benefit is available. But in case of 3 transaction, 112 benefit is not available if STT is not paid at the time of purchase. First, acquired the share during the delisting period. Second, acquired the share through the preferential issue. Or third, acquired the share out of the recognized stock exchange. But there are certain exceptions of this transactions also. Now next part, all people please pay attention. What will be the cost of acquisition whenever section 112 is applicable? So whenever section 112 is applicable, cost of acquisition will be whatever your actual cost, that will be your cost of acquisition. But try to understand. If any equity share or unit that is acquired before 1st Feb 2018. Any share or unit acquired before 1st Feb 2018 and transferring on or after 1st April 2018 means you section 112 is applicable when you transfer that share or unit on or after 1st April 2018. But you acquired that share or unit before 1st Feb 2018. In that case, whatever FMV as on 31st January 2018 benefit is available. Means how you will calculate the cost. All people please pay attention. How you will calculate the cost? There are 2-step process. First is take your actual cost. And second, compare that with lower of FMV as on 31st Jan 2018 or sale value, whichever is lower, and whatever lower comes, that compare with this lower and cost of acquisition, whichever is higher, that will be your cost of acquisition. So what I am saying that all people please pay attention. If you acquire the shares or unit before 1st Feb 2018, because that Finance Bill 2018 was introduced by the Arun Jaitley as on the 1st Feb 2018, and before that you know that there was section 1038 and capital gain was exempt and all. There were no capital gain. They introduced the capital gain. So they are saying that there is a, like you can say that they are giving the benefit that whatever FMV as on 31st Jan 2018, that will be treated as the cost. But how you will calculate the cost, that is given in section 55. First take the whatever your actual cost and just take the actual cost, and second FMV as on 31st Jan or full value of consideration, whichever is lower, and compare, and actual cost whichever is higher will be your cost of acquisition. But now question is that how you will compute the cost of how you will compute the FMV as on 31st Jan 2018. So for computation of FMV as on 31st Jan 2018, there are 2 parts. Suppose if there is a listed share or security, listed share or unit on 31st Jan, if there were listed on 31st Jan 2018, then take the highest quote of that share or unit as on 31st Jan 2018, that will be the FMV. But suppose if there were no trading on 31st Jan 2018, then whatever the preceding date, if trading was happen on 29 Jan or 28 Jan or 27 Jan, whatever last preceding date, whenever trading was there on that particular security, take the highest quote of that date. But suppose that equity share or unit were not listed on 31st Jan. Now it is listed, but on 31st Jan, suppose that is not listed. Then in case of unit, take the NAV as on 31st Jan 2018. But in case of the share, how you will calculate the FMV as on 31st Jan 2018? Take the cost of acquisition of that share and multiply by 272, that is index of the previous year 1718, and divide by index of the year in which you acquired the share. So what I am saying that suppose share unit were listed on 31st Jan, listed on 31st Jan, then you have to take the highest quote of that date. But suppose that was not listed on 31st Jan, then in case of the unit, you have to take the NAV as on the 31st Jan 2018, and in case of the equity share, take the cost, multiply by index of the year, that is 1718, and divide by index of the year in which it was acquired. You got my point or not? Yes. Now next section is 111A. 111A is saying that if there is a short-term capital gain on equity share or equity-oriented mutual fund or units of business trust, then short-term capital gain will be taxable at the rate 15%. Condition is that STT should be paid at the time of sale. Only condition is at the time of sale. In case of equity share also, STT should be paid only at the time of the transfer. Then STCG is taxable at the rate 15%. Against STCG, under section 111A, the deduction under chapter 6A is not available. One more thing, in case of IFSC, STT is not available, then also assessee can get the benefit of 111A. And in case of any other capital gain, long-term capital gain taxable at 20%, short-term capital gain taxable at normal tax rate. There is a proviso to section 112, and 112 proviso is saying that if there is any listed security other than unit, and zero coupon bond, there is an option to pay the tax 10% without indexation and 10% without indexation and 20% with indexation. But nowadays this proviso is not applicable. Nowadays this proviso is applicable only in case of the listed preference share. Basically, if there's a listed equity share, then obviously section 112A is applicable. You got my point or not? Yes. Now there is one more point. All people please pay attention. In case of the non-resident and foreign company, if there is any LTCG on unlisted shares, unlisted security and share. What I am saying that in case of non-resident, if there is a long-term capital gain on unlisted share and security, then that is taxable at the rate 10% without first and second proviso benefit. Means first proviso, that non-resident conversion into foreign to Indian currency, that is not applicable, as well as the index benefit is also not applicable. Now try to understand. Okay, sir, question is that suppose if there is a LTCG 112A or STCG 111A or LTCG 112, that is 20% LTCG, can we claim the basic exemption benefit against LTCG? Answer is yes. This benefit is available only to resident, individual and HUF. What I am saying that resident, individual and HUF. So if there is a resident, individual and HUF and your other income is lower than basic exemption, then unexhausted basic exemption can be claimed against LTCG 112A, LTCG 112 and STCG 111A. You got my point or not? Yes. Now question is that, okay, sir, whenever we trade in the share and all, so when shares and security will be treated as capital asset or stock in trade? Because if it is treated as stock in trade, then your income is taxable under the head PGBP. But if it is treated as capital asset, then income is taxable under the head capital gain. So when it will be treated as capital asset or stock in trade, that depends on the fact to fact. You have to check the fact. Now there is one new Cbdt circular, that is Cbdt Circular number 6 2016, and this circular is saying that all people please pay attention. First thing, the circulars are applicable only in case of the listed security, and you know that in the market 99% transaction took place in listed security only. So lawmaker is saying that where assessee itself declare income under PGBP, means assessee himself declare security as a stock in trade irrespective of period of holding. In that case, assessing officer will not dispute that. What I am saying that first part. If assessee himself declare security as a stock in trade irrespective of period of holding, then assessing officer will not dispute. And second point, in case of listed security, if that listed security is held for more than 1 year, and assessee declaring that security as a capital asset, then assessing officer will not dispute. But if assessee is declaring at capital asset, then he cannot change his stand in the future years. You got my point or not? Yes. But in case of the unlisted security, obviously in case of unlisted security, there will be always a capital gain. In case of unlisted security, there will be always a capital gain only. Okay. But suppose if that transaction is questionable, transaction itself is questionable, there is you can say that the lifting of corporate will type of transaction and all. In that case, assessing officer may take the another view in case of unlisted security. You got my point or not? Yes. Now next part and last part is related to section 55A, that is reference to valuation officer. Question is that can assessing officer transfer your case to valuation officer if assessing officer is not satisfied with the fair market value? Because FMV concept, there is a FMV concept under section 45.2 also, 45.4 also, FMV concept, FMV as on 1/4/2001 also. There are at lots of places there is FMV concept. So suppose assessing officer is not satisfied with the FMV concept, as FMV declared by the SSC, then can he transfer case to the valuation officer for computation of FMV? Answer is yes. In two cases. First case, suppose FMV claimed by assessee as per the registered valuer, means assessee submitted the registered valuer report and he claimed the FMV as per registered valuer, but assessing officer think that there is a variation in AO FMV and that registered valuer FMV. Means assessee whatever claim FMV and AO FMV, there is a variance. In that case, assessing officer may transfer your case to the valuation officer. Or second part, suppose assessee claim the FMV and there is no reference, like he not claimed through the registered valuer and all. Himself, like assessee himself calculated the FMV and he claimed the FMV. And assessing officer think that whatever FMV of assessing officer is higher than FMV of assessee. FMV of assessing officer is higher than FMV of assessee by what amount? 15% of value claimed by assessee or 25,000, whichever is lower. If higher by whatever lower amount you will get, and difference between AO FMV and assessee FMV is higher, by AO FMV is higher than this amount, in that case AO may transfer your case to the valuation officer. You got my point or not? Yes. So this is the completion of your topic capital gain. Hope so you enjoyed this topic. So this is the capital gain topic. Just you have to listen this topic 2-3 times and after that just go through the question from your compiler. You will able to understand this topic and you can get the very good grip over this topic. Okay? So thanks a lot people. Hope so you are enjoying this revision lecture, and if you enjoy this revision lecture, then my request to you, please share this revision lecture with all of your friends. Please press the bell icon, subscribe my channel and also like this video and share with your friend. And my new batch is going to start from 14 July only, exclusively for South Indian student in English, 100% English. So you can refer your junior for that particular batch. So thanks a lot people, and please focus to your study, whether your exam will be going to held in the month of the July or November, whenever there will be an exam, obviously you have to appear for exam, you have to prepare, you have to continuously focus to your study only, give at least 8 to 10 hours every day for your study, then only you can clear this exam. So thanks a lot people, thanks a lot to give me the 1 hour 45 minutes today. Thanks a lot people. That's enough for today.